Everyone, Sam here. Happy Friday. Welcome to another edition of the Trade of the Week. Great to see everybody. So today what we are going to talk about is a concept. And it's a concept that is it's part of the strategy that is extremely important. And we're going to use an example of a swing trade after we go through kind of this concept and key piece of the strategy. Again, good to see everyone. All right. So, yeah, we'll look at a swing trading example in the NASDAQ. And the focus is going to be the novice space. And I want to share something with you that'll kind of tie everything together in just a moment. So as we dive in, always remember, I and the team, we are not investment advisors. Certainly work with investment advisors, help them and all that, but that's not what we do. And of course, there's no guarantee of success. Don't forget, this is very risky. In fact, we're going to spend most of our session on the risk and how important it is to understand it, and then obviously be okay with it. But you'll understand where I'm going with that in just a few minutes. So let's dive in. Now, we've looked at this before. Some of you may not have seen this, but I asked Google a while back. I said, Google, what percentage of traders lose money? Google says 96%. So then I said, okay, what are these 96% doing? In other words, Google, what are the most popular trading strategies? And you can see the list there. There's more, but those are kind of the top 5, right? Trend, right? Adding trend, focusing on trend and Fibonacci and all that stuff. So if you think about it, when I saw this, it's like, I've kind of known this. Now I don't know exactly what the numbers are, but let's focus on this for a little bit. And even as we get into the charts in a few minutes, I want you to remember this 96.4, right? 96% of people don't do very well. The other 4% do. So what are they doing? Well, again, that takes me back to my early days on the trading floor of the Chicago Mercantile Exchange, right? Started on a trade desk on the professional side of the business, working for a financial institution. And as I've said before, my job then was to facilitate institutional order flow. What I noticed right away in handling the actual orders from banks, financial institutions, money managers, hedge funds, and also retail traders and investors was that, one group, right, the professionals tend to be right in their decision-making process most of the time, and as a whole, tended to make quite a bit of money. At the same time, the novice retail trader and investor tended to be wrong in their decision-making process most of the time, and as a whole, either lost money or never came close to achieving their financial goals. And I saw the gap in performance between these two groups was so wide. Now, what hooked me into this business was the very moment that I realized, wow, this group does so well, this group does so poorly, and they're both buying and selling in the same market. So what's going on here? What is one group doing that the other isn't? Does that make sense? And that really got me excited to dive into this industry and figure it out. So I was very fortunate to have all of the orders in front of me, the puzzle pieces in front of me. So I started to bring price charts over to the trade desk. Now I remember I couldn't trade my own account. It was illegal for me to trade my own account, right? I know I've told this story a million times, but it's important that you understand this element to it. I couldn't trade my own account. It was against the rules because I had access to those orders. So you can't lose, right? You wouldn't lose. So what I did was, once I was done organizing the buy orders, the sell orders, demand, supply, and you had big stacks of orders, you knew where the market was most likely to stop falling and turn higher, demand, and where the market was likely to stop rallying and turn lower, supply. Had the orders, right? From big banks, institutions, money managers, you name it. And So I would bring the price chart over to the trade desk and I would put lines around the price points where those orders were at. And sure enough, price would just move from demand to supply, back again until those orders were gone. And then they would move to the next set of orders, right? All right. Good job, Ryan. We'll actually probably talk about that euro in just a bit. Nice job. Nice job. That was probably that was dollar into demand, euro into supply. Is that correct? Yeah, that was a good opportunity this week. Anyway, good stuff, and congrats. So back to the story here. So what I realized was that, and then when you track, so then I said, okay, I see what the professionals are doing because I have the orders, right? And this is how supply and demand works. This is how it's created, all that. But then I saw that novice retail trader and investor, or the 96%, right? I said, let me track that activity as well. So every time we would get an order from that group, I would put a little dot on the chart. And sure enough, that's when I almost got the chills. I remember, the week where I was like, wow, okay, this is a big light bulb that's going off. And it was that, when you track like that, you see, wow, when one group is buying in a big way, the other group is selling. And when one group is selling, the other group is buying. At key turning points in the market, both groups are almost taking the opposite action, right? And it's a little more than that, but that's a big piece of it. Yep, there you go, Ryan. Yeah, we'll talk about that in a bit. Yeah, the dollar and euro came into nice opposing levels right at the same time, as they mostly will, right? The euro does take up a big slice of that dollar index weighted pie. So good stuff there. So, from that moment on, right, it was time for me to keep making sure I'm tracking this with charts, and quickly, it became very obvious what the picture or pattern that looks like on the price chart. And it's all about identifying that massive supply and demand imbalance. Okay, so we're going to talk about that in a minute. But let's, don't forget this 96.4. We're going to come back to that. So we've looked at this before. This may be new to some of you, but this is location map. So the rules to the strategy really come down to two things, right? Structure of a supply-demand level and location of that supply-demand level. But the mistake most people make is they just focus on supply, and or demand. They don't focus on both. And the real answer is not, people look at a supply or demand level, what they think is a supply-demand level, and they'll say, okay, is there a lot of demand there, or is there a lot of supply in that level? That's the wrong way to think about it. The right way is to combine both. In other words, what's the level of imbalance? Because think about it. Supply and demand is everywhere, right? It's everywhere. In other words, every time you have a trade in a market, it's because of a willing buyer and willing seller. So every single transaction is because of supply and demand, right? And you have little imbalances all over. Anytime price in any market, stocks, futures, forex, whatever, even goes up one tick or 1 penny, that's because there was a supply-demand imbalance there, right? On the demand side. Wasn't a big imbalance, but price went up because of that supply-demand imbalance. Does that make sense? And so my point is, but when price comes back to a level like that, that's not a demand zone that has a big supply-demand imbalance, so price is not likely to turn. Therefore, we're not interested in buying a pullback to that level, right? And so what I'm getting at is, there are supply demand and supply demand zones are, they're all over the place. What we want to get good at and focus on are the supply and demand zones that have the greatest imbalance, because that's where the probability of price turning is highest, and those levels are also associated with the largest profit zones. So I hope you understand what I'm saying by that. It's not just supply and demand. That's the mistake everybody makes. That's everywhere, right? Focus on the imbalance. And if you look at the screen here, so on the left, we have our, our red and green friends here, our supply, demand, and in the middle, we call that the novice space, right? And this is potential, right? We talk about potential volume because these are willing sellers. They haven't sold yet. The green people on the bottom are willing buyers, demand. They haven't bought yet. Okay. And what this diagram means is, right, down here at demand, the imbalance is greatest on the demand side, obviously, and up at the top, the imbalance is significant on the supply side. In the middle, you don't have a big supply-demand imbalance, right? However, where does price spend most of its time? Where do most market participants enter and exit positions? It's in the middle, right? You look at any market, any almost reference point in any market. It's the curve here, right? The vast majority of volume is in the middle, and very little volume out at supply, very little volume out at demand. Why? Because there's so much competition to buy at demand and so much competition to sell at supply, that price gets forced back down to the middle. What would you say is the percentage of, what would you, when you think about percentage of, where price trades at, right? So what percentage of trading activity do you think is in the novice space in any market? What would you say to that compared to the percentage of trading activity that's out at supply or out at demand? What percentage of trading activity is in the novice space? What do you think? And again, the reason why we get that is because there is not a significant supply-demand imbalance in the novice space, right? There's a lack of significant supply or demand there. That's why you get, the imbalances, or lack of major imbalances. That's why you get so much activity, right? And that's what the big red and green bars here mean. It means, yes, there's tons of buyers, but there's also tons of sellers. Supply and demand is not that out of balance. However, out at supply, the imbalance is significant. Down at demand, the imbalance is significant. Yeah. So it's about, right? It's about 95% of trading activity is in the novice space, right? Let me ask you another question. What percentage of traders lose money? What percentage of traders lose money? 96%, according to Google, right? You see where I'm going with this? Okay. Now, think about it. What is the number one strategy or strategy rule that people use, that 96% of people use? What's the number one filter people have in their strategy? It's trend. But here's the big question. If you don't buy at demand and have to wait for a big uptrend to be underway before you buy, where are you buying? If you don't sell at supply and you have to wait for a big downtrend to be underway before you sell, where are you selling? Think about that. Answer that question. Right in the novice space. So, while almost every trading book and trading education, this and that out there has you focus on trend, don't just follow trend because everybody else is following trend. There's a reason why 96% of people lose money and the very small 4% don't. Does that make sense? Okay. All right, let's keep going. So we don't, and this was a great week to have this topic because The stock markets around the world simply over the past week and a half traded from demand up through novice space, and quality supply has been higher, right? So we don't even look at supply demand zones that are in the middle. That's our no trade zone. However, and we color code our supply demand levels. So our gray supplier demand levels, those are somewhere in the novice space, near the top or the bottom. So sometimes we'll take those if they're near the bottom or top of the novice space, but never in the middle. And then of course we want to focus on our levels out here, right, at supply and demand. Why? Because the probability of success and profit zones are huge out at supply. The probability and profit zones are huge out at demand. Probability of your trade or investment working out for you in your favor in the novice space and those profit zones, very low. Certainly not worth risking money at. All right. So what does this picture look like on a price chart? And again, these sessions are meant to be about, 15 minutes, 30 minutes long. So focusing on the novice space, we see that the presence of lots of trading activity, right, which happens because there's a lack of a significant supply-demand imbalance in here. The presence of lots of trading activity strongly suggests novice space. If there was a big supply-demand imbalance inside here, this picture would look nothing like this, right? Price would take off and not come back. But we have the opposite picture. This is the novice space. Looking at an opportunity that we found a little bit ago, this is a swing trading opportunity in the big stock markets, right? Russell, NASDAQ, even the others. In one of our live sessions, I was delivering a live session for our members. We always go over the evidence. The first thing we do is go over the evidence. And what we were saying back here is equity index markets are at tested demand zones. So the NASDAQ was down here for a second time. The Russell was down here for the first time. And the question was, are markets likely to move higher? And we said it's possible. However, they're likely going to need help from the dollar to do that. Sure enough, the NASDAQ and Russell were into demand with big profit zones to the upside. And if you look back around that date, that's when the dollar hit supply. So everything lined up for us and the markets took off. But let's focus on the Russell. So there's the demand zone. A little bit after the session, or actually during the session, that came right into our demand zone and then moved higher, right? But take a look. Now follow me here. This is the important part. Think about novice space. So when price was down into the demand zone, right, and turned higher, what did it have to move through to move higher? Well, the first thing it had to go through is all of this. Is that a significant supply-demand imbalance? No, it's clearly novice space. We just showed you that. Next, and it moves through there, very easily, again, because there's nothing to stop it. Next, it has to move through all of this right here. Does this picture represent a significant supply-demand imbalance? Nope. Represents novice space, clearly. Okay. Price moves through there with ease. Next, it has to go through this. Does this picture represent a significant supply-demand imbalance? Nope. Clearly represents novice space. Price moves very easily through novice space because there's a lack of a significant supply-demand imbalance to stop it. And, of course, the most important thing is at the time, even, before price comes down for your entry point, in this case on the buy side, we know all this information already. Does that make sense? Okay. So anyway, hopefully you get the point and understand. Now, let me ask you this, right? Again, if you wait for, let's think of that 96%, what do? They don't buy at demand. They wait for price to turn higher. They wait for a series of higher highs and higher lows, right? And then they buy. Well, again, where are they buying? Are they buying at demand or are they buying in the novice space? 96% of people lose money trading, don't do what the 96% do. The goal is to stop thinking and acting like a novice retail trader or investor and simply start thinking and acting like a professional bank, financial institution, you name it. Now, what the vast majority of people do is they load their charts up with indicators and oscillators and all kinds of tools. But whether it's trend or an indicator, an oscillator, you name it, what do they all have in common? Right? They're all a derivative of price. They're all going to do what price has already done. They lag price. Adding any tool or strategy that lags price to your decision-making process, by definition, does three things that hurt you. It adds risk, decreases reward or profit zone, and it has you buying and selling in the novice space. Right? Exactly. Yeah, Mark, that's a problem. It's the 96 and the 4%. And the nice thing is, here's the thing. When it comes to doing this and thinking about this the right way, everyone knows how to do it already. Most people just aren't aware of that. Like I've said many times, how you make money buying and selling anything in life is exactly how you make money buying and selling in the financial markets. On that note, hopefully that was helpful. If you want more information or, to take this deeper, you can always go to one of the financial strategies workshops. And some of these fill up, but there's some dates that I think are open, might be open. And in there we cover some more rules on the strategy. Again, hopefully that was helpful. And have a great weekend, and we'll see you next time.